Welcome back. In the last video, we talked about joint ventures and how its hedged ownership profile is very appealing to many businesses that might have a level of capital restrictions that prohibits full ownership. In this video, we take a look at the other side of the coin, equity investments. Establishing a new footprint of operations via full-scale direct expansion is typically expensive and requires a major commitment of managerial time and energy. However, political or other environmental factors sometimes dictate this approach. There are three basic investment forms, although there are more levels of investment than forms. The first is greenfield investments. This is a market entry strategy that entails direct investment in a factory, retail outlet, or some other form of new operation in the target market. The benefit of this method is that it is not encumbered by or constrained by prior work. Read reputation. Pursuing a merger is an alternative. We don't have to look far to find well-known examples. One of the largest in the media space is currently in the late stages of unfolding. Comcast's agreement with General Electric for a 51% stake in NBC Universal will create one of the world's most dominant media companies. Acquiring an existing entity is often the most used path of the three alternatives. This approach is taken for several different reasons: to eliminate an upstart threat, pull mission-critical resources in-house, secure a substantial foothold in a new market. Despite the reasoning, this is an instantaneous and sometimes less expensive approach to market entry or expansion. Although full ownership can yield the additional advantage of avoiding communication and conflict of interest problems that may arise with a joint venture or co-production partner, acquisitions still present the demanding and challenging task of integrating the acquired company into the organization. Deutsche Bank's raise of £8.1 billion to complete the Postbank takeover is a great example. Germany's biggest bank is to issue 308 million common shares to buy the 70% of Postbank it doesn't already own. The business rationale? To expand their strong position within the home market, take a leading position in the European retail banking business, and significantly enhance the bank's revenue mix. If you have any doubt, check out the findings of PwC's study of the 2008 marketplace. Despite being a year in which most equity and credit markets were frozen, mergers and acquisition activity was only down 22% to some 1.1 trillion US dollars. The alternatives discussed in this series, exporting, licensing, joint ventures, ownership stakes, are all points along a continuum of alternative strategies. The wise strategist understands that a combination of these methods might yield the best long-term results. Combinations are put together both based on concurrent situations and also timing. It is not uncommon for mid-course adjustments to happen. Radically shifting the strategy as the market players become wiser is very common. In the next installment, we will explore how political, economic, and technological environments have conspired to change the relative importance of market entry strategies. Inside the next video, we're taking a look at strategic partnerships. Thank you for watching. If you would like to see more videos, go to donaldmcmichael.com.